This is level 2 of the CFA program, the topic on corporate issuers, and the reading on mergers and acquisitions. You've likely noticed that this is a super long reading, and you probably are not surprised that we have a super long slide deck for you. But I will say this before we look at the LOSs. Everything that we're going to learn inside of this slide deck was taught to us by Modigliani and Miller in their 1958 seminal paper on capital structure. And by that I mean we're going to learn very simply that the merger and acquisition game is just an application of capital budgeting principles. We're going to accept a merger or an acquisition if it has a positive net present value. Now, there's lots more to it than just computing cash flows and the weighted average cost of capital like we did back in that capital budgeting reading, but the foundation is laid by M&M. Look at the LOSs. We have 2 slides on these, so I'm not going to read all these to you, but we will go ahead and talk about mergers and acquisitions. We'll talk about bootstrapping pretty quickly, takeover mechanisms, and valuation. And so notice a couple of these here towards the end of the LOSs are sound like estimate and calculate some kind of a value based on cash flows. And that's what I was referring to with that M&M discussion. And then we'll have a couple of slides at the end on restructuring and some motives for restructuring. So let's go ahead and get started with a super brief recap here, making sure that you understand the difference between an acquisition and a merger. And the 2 illustrations right there pretty much summarize that difference. For an acquisition, we have one company purchasing the equity shares of another company and then controlling it. So you have company A plus company B, and that leaves us with company A. And of course, company A over there on the right side of the equal sign ought to be just a little bit bigger than it is over on the left-hand side. A merger, on the other hand, and the reading uses this word absorption here. You have one company that stops existing. So, up at the top, you could have 2 companies, kind of still remaining in existence. And you probably could have that down under mergers as we see the different types of mergers that we'll go through over the next couple of slides. But essentially, you have company X and company Y, and then there's a new company, newer meaning that it absorbed the target company. Just a brief portion down there at the bottom. Look at that last circle point. The reasons for mergers that have been announced over the years include things like market power, growth, and diversification. And of course, the big one in there in the middle is synergy. We're going to go ahead and evaluate some of those for their kind of accuracy or ability to generate synergies. Some motives for mergers are super good and some are super bad. So we'll talk about those in just a little bit. All right, let's look at that first LOS, classify mergers and acquisitions. All right, so this is pretty standard definitional stuff. So a statutory merger is one in which an acquiring company purchases all of the target's assets and liabilities, and so that target company ceases to exist. Subsidiary merger, on the other hand, the target company becomes an acting and living and breathing subsidiary of the acquirer. And so look at the math down at the bottom there. You have company A and company B, and that equals, well, company A and company B, but notice the parentheses outside of that is that that company B probably continues to exist. And then, of course, under a consolidation, a new company is formed. Look at the middle circle point there. Company A and Company B turns out to be Company C. One interesting exam possibility there is that final circle point there. And this is noted in the reading, common in companies of the same size. And so if you think about this, you have 2 companies that are this big, and then they form, a company that's, let's say, twice as big. And so you want to have a new company with probably new board of directors, although it'll consist of, parts of those individual boards of directors, and then management, etc. Guessing you remember this back from level 1. I could probably just take just a second here. Horizontal mergers, vertical mergers, and conglomerate mergers and acquisitions. Of course, these are exactly what the name suggests. Horizontal goes like this, same business. Vertical goes like this. Think of it in the as different parts of the supply chain. And then conglomerate just simply means that we don't have any correlations with our business. All right, here's where we start to get interesting, back to our conversations on Modigliani and Miller. What are some good motivations? And notice the first one listed, and this should be the primary one, is this concept of synergy, meaning that we have two companies that have a certain value and a certain ability to generate cash flows. And if these two companies each have a value of 1, and you say 1 plus 1, I guess in math that you learn in kindergarten, you would say that equals 2. But of course, synergy means that this is going to be some number greater than 2, maybe 3, maybe 5, maybe 10. And the sources of synergy mostly come in two categories, revenue enhancements or the capacity to minimize expenses. So think about it this way. Those synergies generally come from the income statement, either the top of the income statement where you have 1 plus 1 equals 3, or from the expense side of the income statement where you have 1 plus 1 equals, let's say 1, or maybe 1.5. So you can enhance those revenues, and then you can reduce those expenses through this concept of synergy. And this occurs through economies of scale and economies of scope and economies of human capital. You put these two companies together that have really, really smart men and women, and they are able to figure it out better so that the operating cash flows, 1 plus 1 equals 4, let's say. Another acceptable reason for merger and acquisition activity is this concept of just pure growth. Companies are looking to grow their revenues. Yeah, that's true, but maybe grow their assets as well. And then that leads right into increased market power. And so you think about two companies that are about the same size, and they merge, and they can increase their market power. Let me just give you a quick economics example. Let's suppose that one company is pretty competitive in its industry, and if it lowers prices by 1%, it can increase its quantity sold by, let's just pick a number, 1%. I don't really want to call this an elasticity. Maybe I'll call it Jim's elasticity here, but it's a measure of sensitivity. And let's suppose that a competitor has similar sensitivities, right? A 1% drop in price results in a 1% increase in revenues, or however you want to measure that growth. But if you put these two companies together and they have an increase in market share and market power and the ability to execute its market strategy, then you have these two firms now converge and merge into one larger firm. If it drops its price by 1%, maybe it increases its revenues by 5% or 10% or some bigger number. So that's like a combination of growth and increasing market power there. I like this one here, acquiring unique capabilities and resources. You think about it, what did M&M teach us? That, we'll accept any project that has a positive net present value. But let's suppose that I'm Jim, right? And I've used the concept of my baking company. So let's suppose I have Jim's donut company, and I'm really good at making donuts. And one day I wake up and I want to make cookies. But my machinery and my workers, they're trained to make the donuts, right? But they're not trained to make the cookies. And so what I could do is I could hire some engineers and some scientists, and I could come up with Jim's cookie. But suppose I look down the street and I say, hey, there's Jen's cookie company. And maybe I could just go buy Jen's Cookie Company or merge with Jen's Cookie Company because it just caught. Boy, what do we have written there? Too expensive when generated internally. Maybe in my example that it would cost, let's say, $1 million for me to put together Jim's Cookie Company. But I could go over and maybe I'm willing to pay, maybe Jen's Cookie Company is worth $1 million. Maybe I'd even be willing to pay 1.1 million or 1.2 million or 1.5 million to get her expertise and bring it into my company. So I do like that acquiring unique capabilities one. But my second favorite here, of course, my first favorite is the synergy idea, but unlocking hidden value here. This is really a cool concept. And so you think about it, when the reading tells us about, hey, maybe this target company, maybe they stink. And maybe if we have, all right, look at those last two words, better management and maybe some reorganization and some possibility of synergies. And of course, that's a focus of this unlocking hidden value. Maybe these executives over there are just not quite up to the level of skill that our executives are. And so if we take over that company, then we can unlock that hidden value. But here is where the concept of this embedded option presents itself, as Modigliani and Miller predicted all the way back in 1958, that there might be something inside of Jen's Cookie Company that we don't really know about today. Maybe Jen doesn't even know about it today. And it might have something to do with baking, but it might have something to do with the production process that we can capture that, put it in a bottle, patent it, and sell it to other people out there. In academic circles, we call that a latent asset. How about cross-border mergers? Some good motivations here, following clients, exploiting market imperfections. I mean, that makes sense. Adverse government policies, that makes perfect sense. Technology there. I like this product differentiation there. I had an opportunity to visit with some Mars executives. Mars, they make all the candy stuff. And it was actually the CFO, and he was telling my class and some other students out there about how cool it is to go and introduce a piece of chocolate to other countries and other cultures, because apparently taste palettes are different throughout the world. And what sounds great here, like a Three Musketeers bar, might sound great here in the United States. If you gave that same Three Musketeers to somebody who has, a completely different evolution of their palate, it might be not quite as tasty. So they have to adjust the molecules and the combination, all that kind of stuff. So all of that, it leads to this idea of product differentiation. And so you think about the knowledge, the human capacity that is being learned over the years of saying, okay, we take this product here in this part of the world, and then we take it over there, and we have to adjust it. Think of the learning curve and all the stuff that you learn from a scientific and an engineering standpoint. And boy, do I even want to go back to this last slide? Go back to that unlocking hidden value. Psychiatrists tell us that we only use, a small fraction of our brain. And I believe that as a parent. But imagine unlocking full brain capacity by being able to observe and engage in all this merger activity. You have to learn, right? And so part of that learning process means an increase in operating cash flows, which is going to lead to an increase in value. All right, I like this one here, dubious motives. Tax considerations. It doesn't make sense to take over a company who really stinks, who has all these losses. And you can, of course you can use that tax benefit to reduce the tax liability. But if the company stinks because it has bad product lines, then the company probably still stinks, right? Now, there is some possibility of synergies and latent assets, all that stuff that I just talked about. But this should not be a primary motive. Diversification, Modigliani and Miller taught us this, that shareholders will never pay executives to do something that they can do on their own, right? Shareholders own well-diversified portfolios, so it doesn't make any sense to engage in merger activity to increase diversification, because shareholders are going to look at the executives and they're going to explode their heads and they're going to say, dude, we've already done that. Tell me why you're doing it. Remember that. M&M taught us shareholders will never pay executives to do something that they can do on their own. Oh boy, we spent a lot of good time talking about the agency conflict, this natural battle between the shareholders, right, who are the owners of the company, and the executives, who are the agents or the stewards of their capital. Managers' personal incentives to increase their power and control, right? Hey, I'm the executive. I'm the CEO of a company that has, let's say, 100 million in revenue. So, I'm pretty important. But if I can merge and merge and merge, and now it's 1 billion, boy, now I'm really super important. Once again, shareholders are going to say, what good is that doing me? And then this concept of bootstrapping, which has its roots in, kind of the entrepreneur using his or her own capital to start a business. And it has some applications in statistics. And of course, we've done bootstrapping. I can't remember if we did that explicitly in level 1. We talked about it in level 1. I know we'll do it in level 2, where we look at the zero coupon yields and the spot rates, and we try to bootstrap so we can put together some kind of yield curve so that we can value a bond or do something else there. But here in this case, bootstrapping simply means that you take one company that has a earnings per share and another company that has an earnings per share. And if there are no synergies, you can show that the earnings per share increases even though there's no change in value. So dubious motives. And so what the Institute wants us to do with this LOS is to show bootstrapping and then calculate a company's post-merger EPS. So let's go ahead and do that. Take a look at this table that we put together over there on the top right, 4.8. That's the calculate a company's post-merger EPS. So pretend that 4.8 isn't over on the right-hand side. So let's go ahead and start with two companies. We have Axon and Symbian. So $200 stock price for Axion, $100 stock price for Symbian, which gives you the idea that, Axion is twice twice as big, but actually it's worse than that, because skip down to total shares outstanding, 200 and 100,000, and then skip down to total market value. So that's 40 million and 10 million. So actually Axon is 4 times as big as the other company. PE ratios right there in the middle, 50 and 25, total shares outstanding, and that gives us that leads us to total earnings. So look there, 800 for Axon and 400 for Symbian. And then notice over in the green on the right-hand column, that's 1.2 million. So total earnings, 8 plus 4 gives me the 12. So that's the line to tell you that there's really no synergies going on. There are no revenue enhancements. There are no minimization of expenses, et cetera, et cetera. So notice what's happening here. We've got 200 of Axon, 100 of Symbian, and what we're going to do is we're going to we're Axon, right? We're going to take 50,000 of our shares and buy the 100,000 of Symbian shares, and that leaves us with 250,000 out there on the right, total shares outstanding. So if you do the 12 divided by the 25, there you get that 4.8, and the math is shown there underneath the table. I know I went through that fairly quickly, but I'm guessing that you could make through this table pretty quickly. And so this addresses that LOS, calculate a company's post-merger EPS. And so remember, if you hit this in a vignette, the Institute is probably going to have to give you a table similar to this, and somewhere in there they'll probably tell you, or even just give you the green row like we did here, that total earnings is just a 1 plus 1 equals 2. How about the LOS on industry life cycles and how it relates to what Modigliani and Miller are trying to teach us about these motivations? So let's first work through the industry life cycle stage down the left-hand column, and I'm going to toggle back and forth between the two slides here. So industry life cycle stage one. So right, pioneer and development, and then followed by rapid growth, followed by mature growth, followed by stabilization, followed by decline. All right, so that's our industry life cycle. And then the characteristics here, and this will probably be given to you, or it could be asked of you in a vignette, but you should probably know these characteristics as they relate to things like profit margins, sales, and competition. And so let's go ahead and start with the pioneering and the development. So what does this mean, right? We don't have lots and lots of sales. We have huge capital outlays, development costs, which means we have low profit margins. But then that switches when we have rapid growth, right? And in that rapid growth stage, we probably have not too much competition out there. So that's probably important. And then under mature growth, there is tremendous potential for growth. And there are probably other firms out there that are thinking, here, let me go back here real quick. They're thinking, all right, and let's just do Jim's Baking Company, right? They're probably thinking, okay, Jim, is this really going to continue? Or is Jim really as good as what he does? Or is he going to fail soon? So that mature growth, so my growth is leveling off. But then as soon as that market starts to stabilize, then these other companies are able to come into the market. And that's where that increased competition comes. So I think that's an important characteristic. And then we've got, when there's decline, then we've got all sorts of bad things. So I think the best questions here in this vignette are to characterize a particular stage in the life cycle, and then maybe ask an introductory question about what this means for sales and competition. But then here's really the core of this question: what's the motivation for a merger during that life cycle stage? So let's look at the development stage. So entry into new markets, right? I mean, imagine just there's an entrepreneur or a group of entrepreneurs that have this idea and they're super excited about it, right? And so, boy, let's just go in and take over that company while this entrepreneur still has all of his or her life ahead of them. And then we can kind of layer our resources on top of their resources. During rapid growth, I think this is kind of what I was talking about earlier. And so we're going to expand capacity and gain access to capital. And then mature growth, here's where those synergies really come in: economies of scale plus economies of scope. So what did I say there? I said revenue enhancements and operational efficiencies, meaning reduction in expenses, operating expenses. The reading refers to that as improved operational efficiency. In stable markets, and remember now, let me go ahead and add another word to all this. Under mature growth and under stabilization, so at mature growth, what we're doing is we're approaching brand name in our product lines. But clearly in market maturity and stabilization, we have a brand name. So now these synergies across financial statements are a great motivation for these mergers. And then in that deceleration stage, we may sell our company to ensure survival. And synergies, synergies throw in are possibilities in almost every one of these motivations, right? That's probably something good to remember. So what types of mergers are common in here? So note in the growth stages, it's probably not vertical until you hit that mature growth phase or in the very final phase. I know I've given you advice over lots of recordings to take pictures of some of our slide decks. And so this one here is probably a good one to take a picture of, and this one here as well. All right, how about transaction characteristics? So if I'm Jim's donut company and I want to take over Jen's cookie company, I can just offer to pay her or her shareholders cash, right? Or I can offer shares of my own stock. I can do it with a combination of my shares of stock, or so I could say, hey, I have a bond as well, or maybe some other kinds of crazy securities out there. attitude of management. And so Jen over here, she can either be my best friend and she could say, you know what, Jim, I've been waiting for you to take over my company for a long, long time. Let's do this in a friendly atmosphere. And by the way, if this is going to be friendly, you need to make sure that I still have a job when you take over my company, and all of my favorite workers over here still have a job. And so that's probably the main characteristic of why an acquisition or a merger is going to be friendly, but it could be hostile if I say something like, you know what, Jen, I don't like anything you do over there. I like your assets and your product line, but I don't want you around, or I don't want any of your workers around. Let me tell you just a quick story that occurred back in the late 1990s. It was in Pennsylvania. There was a company called AMP Incorporated that was received a takeover bid from a company called Allied Signal. And it was fascinating stuff. I still use this example in my classes, is that the Allied Signal executives made an announcement. They made a direct appeal to the AMP Incorporated shareholders. They said something like this. Now, of course, I'm paraphrasing. They said something like, dear AMP shareholders, are you aware that your executives, they're not very smart. We want to come in and take over your company, and we'll do all these great things, right? All the motivations that we talked about in the previous slides. And so AMP responded by saying something like, hey, you know what? Let me tell you all the bad things about Allied Signal. So this was a classic example of a hostile takeover, because the Allied Signal executives were going to come in and fire all of the AMP executives. And then, of course, this went back and forth for a number of weeks, and Tyco actually came in and took over AMP Incorporated. I say that to you because when I was in college, I was a great AMP worker. I worked from 3 to 11. I sat at a machine, ka-ching, 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 making little parts for computers for 8 straight hours. So that's why I know that story. I'll come back to that in just a little bit. All right, forms of acquisition, stock purchase. All right, so think about this. The target has a balance sheet, right? And the target firm has an equity portion of the balance sheet, and it has outstanding shares, and those shares, maybe they're traded on the New York Stock Exchange, or maybe they're just traded between and among family members and friends. But nevertheless, what I'm going to do as an acquiring firm, I'm going to say, hey, I want to buy 51% at least of those outstanding shares so that I can take control of the company. So I can offer cash, I can offer my shares of my own stock, or maybe even some bonds as well. This is going to require approval of those target shareholders. And of course, the target shareholders have a tax liability. Now, if I pay cash, they have an immediate tax liability. If I pay shares, then it's deferred until they actually sell those shares. And so, of course, what happens is that then I assume the entire financial statements of that target firm, including its liabilities. So that's an important concept there. And we'll talk about that when we look at takeover defenses. So think about that first part, is that the acquiring firm is looking solely at the equity portion of the target's balance sheet, so that it can gain control of the board, so that it can gain control of those assets. But a simpler version is for the acquiring firm executives to just approach the target executives and say, hey, we really like one of your assets. Would you buy it? Would you sell it to us? And this, of course, happened, probably 2002 or 2004, when Procter & Gamble sold its Jiffy peanut butter product line to Smucker's. No shareholder approval, and of course, there's no assumption of liabilities. And this happens all the time. Businesses are selling. Now, they don't really call it, like we're selling our product line. They say, well, we're selling this particular business segment. All right, so what can I do? I can offer cash and I can offer securities. And if I offer securities, there'll be an exchange ratio based on size, which is a little bit similar to what we did in that earlier example. So here's a good chronology of a friendly merger. And, friendly merger implies that everyone is friends and that everyone's happy and that everyone's going to be happy after the acquisition. And as I said earlier, the most important part of this friendliness means that the acquiring firm is going to retain retain the employ of the target managers. And so think about this target management approach, right? Merger discussions, due diligence. I mean, this is important. Due diligence means things like, okay, let's go ahead and estimate cash flows. We're going to do that here in just a little bit. And then we'll sign an agreement, and then we get shareholders and regulators. That means the government. In there. When I teach my graduate classes about mergers and acquisitions, and I work through this, a similar kind of a process here, I always relate it to my personal marital decision, and I think it's appropriate here. And indulge me here for just a few seconds. Target management approach, merger discussions. So my wife and I, we decided, okay, we like each other enough, and we probably could build a life together. We compare our product lines, right? My wife said, hey, I'm a really good cook. And I said, well, I can take out the garbage. So we have all these, kind of similarities and combinations and synergies, right? Due diligence performed. So then, I teased my wife. I'd say, oh, after we thought about getting married, I went out, I interviewed all these other girls. And I said, hey, I have this one offer over here. Can you beat it? And it provides lots of comedy. And my wife, she just laughs at me like she always does. So then we got married, right? We said, I do. And then that last thing over there, this is the funniest part here: approval by shareholders and regulators. When I told my father that my wife and I were getting married, he tried to talk me out of it. How about if I just whisper that one there? And it didn't have anything against my wife, but he just said, you know what? He was like, dude. Marriage is not all marshmallows and strawberries. So. And then my dad ended up loving my wife. Hostile mergers. This is super exciting to talk about and super exciting to witness, like the AMP Incorporated and the Allied Signal. Because when two people are fighting, it's much more interesting than when two people are holding hands, right? And so target management is against the merger, and mostly they're against the merger because they're concerned about their own employment future. But target management can also say something like, you know what, this acquiring firm is coming in and making a bid, and this is way lower than what is a reasonable or a rational bid. So we're going to go ahead and fight it so that we can get a higher bid as good stewards of our shareholders' capital. All right, so that's important. I mean, there are good reasons to try to prevent a merger, but there are also poor reasons to do so as well. And so what can happen here? There can be bear hugs, right? Trying to circumvent the target's management, the executives, by just appealing to the board of directors, right? What did we say in a previous recording? It's the board of directors' job to essentially provide strategic planning and hiring and firing executives. And so that board could consider this in the absence of those target managers. Tender offer, which simply means that the acquiring firm is going to come in and say to the shareholders, hey, you know what? Your stock price is $100 a share. How about if we pay you $150 a share? And by the way, the average takeover premium in the tender offer market is around 50%. I'll come back to that in just a little bit. And then a proxy fight. This has become super common in after the year 2000, mostly because it's way cheaper than a tender offer, right? If you're trying to buy 51% of shares and you're offering a 50% premium, this is not $10,000. This is hundreds of millions, billions of dollars out there. Or you can just appeal to the shareholders and say, hey, look, your board is not doing the right job. Vote for me. And that's through a proxy contest. All right, here's an LOS that I like. Distinguish among pre- and post-offer takeover defense mechanisms. All right, so let's suppose we're the target executives and we're against this merger, either for the good reason that we think the offer is way too low, or we want to preserve our jobs because we think we can do the better job maximizing shareholder wealth. So what are these pre-offer takeover defenses? So these are defenses that occur before anybody is interested in us as a target firm. I'm going to go ahead and start at the bottom here. Restricted voting rights means simply that if a certain shareholder, right, a certain acquiring firm accumulates enough of our shares as an ownership position, like 2% or 5% or 10%, then we could impose some kind of restricted voting rights that, hey, even if you have 10% of our company, you can still only vote 1% of those shares. We can also do something simple by incorporating in a state with restrictive takeover laws. This happens all the time. A fair price amendment simply means that we can amend our company's charter that says something like, hey, if our stock price is 100, in order for us to consider an offer, it has to be a fair price. And let's just suppose a fair price is $150, let's say a 50% premium. And so our corporate charter prevents takeover or an acquisition if the offer is $110 or $130. So notice we have in bolded there, below a specific threshold. And then we can do this staggered or classified board of directors. I'm pretty sure I've talked with you guys about this before. Let me just do it quickly. I mean, most companies re-elect their board members every year, and those board members serve a 1-year term. But what you can do is divide those board members into different classes or staggers or units. And you could say something like, okay, a Class A board member will be elected and serve a 3-year term. And then the following year, a Class B director will be elected and serve a 3-year term, and then a 3-year term. And so you have an election of only a certain number of board members every year, which notice we have in bold there. It takes longer to elect. So you just think about a simple example. If there are 6 board members, and there are 3 classes that each serve a 2-year term. So if I want to take over the board, even if I have 100% of the votes, the most I can get that first year is just 2 seats, 2 out of 6. That's not a majority, and so it should be obvious that that prevents a takeover. So let me swing back here to this first one. Notice there's a poison pill and a poison put. These things are common by the name poison, but they don't have too much other in common. But let me go ahead and just let you know that at least a third of my dissertation was on poison pill securities. And I won't bore you with all the details, but the reading does mention a couple things that I want to emphasize so that you can make certain that you get this question correct on the exam. When the executives adopt a poison pill, they don't go to the shareholders and say, hey, here's a pill. It's poisonous if you swallow it. Would you like me to give it to you? Of course, the executives don't couch it in those terms. They use the following term. Are you ready for this? A shareholder rights plan. And so instead of a poison pill being handed to the shareholders, they say, hey, here's a rights plan. Who wouldn't want a rights plan, right? This is a classic example of framing that we'll talk about in behavioral finance. So if it's framed, hey, here's a right. Wouldn't you like to have a right? Of course. Who doesn't want rights? So what this does is you get a right. It's typically in the form of a preferred dividend. Even if you're a common shareholder, you get this right in the form of a preferred dividend that gives you the right to buy shares of stock in our company at a super discount in the event that an acquiring firm comes in and accumulates a certain threshold of ownership in our company, like 5%. All right, so think about what this means, that an acquiring firm comes in and gets, they own 5% of our shares. This triggers this shareholders' right plan. So now what you can do is you can take this right and you can come back to the executives and say, okay, I'm going to buy a share at a deep discount. Now, if our stock price is 100, that price might be $5. So this sounds like a great deal, right? So you can take your right and buy a share of stock for $5. Now the stock is trading on the New York Stock Exchange at $100. So you can buy it from the executives for 5 and then immediately run to the New York Stock Exchange and sell it for 100. That sounds like a great deal. Who wouldn't want that right? But let's read the fine print. The fine print says, you know what, this right, it doesn't give you, let's suppose you only have 1 share of stock. It doesn't give you the right to buy just 1 of my shares. It gives you the right to buy, let's say 20 shares at $5. Okay, so you come to me and you buy 20 shares at $5 a share. So you run to the New York Stock Exchange. But remember, you're not the only one who's doing this. Everybody who owns 1 share is buying 20 from me. This is a massive flood of shares into the market. And here's what's going to happen. By the time you buy those 20 shares from me for $5 and get in your car and drive to the New York Stock Exchange, everybody else who are shareholders will have already done that. There's a massive flood on the New York Stock Exchange of outstanding shares. So the price will have gone from $100 all the way down to, let's say, 50 cents. So there's no way you're going to buy from me at $5 and then go sell at 50 cents. Do you see the nature of the poison? This is poisonous. Now, the reason that this thing's work is because it's discriminatory. It precludes the acquiring firm from participating in the rights plan. So think about this. The acquiring firm comes in and spends a ton of money buying 5% of my firm. Let's just say it's $50 million. And that $50 million then turns into like $8 on the floor of the New York Stock Exchange. So these poison pills, they have never been executed because they're poisonous. Nobody in their right mind would want their stock price to go from $100 down to 50 cents. But what this does is it prevents a takeover. In fact, going back to my AMP Incorporated, AMP had a poison pill. And so it did not deter Allied Signal from coming in, but what it did is it gave AMP Incorporated executives tremendous negotiating power. And so those negotiations with Allied Signal fell through, and they ended up being bought by Tyco, and they redeemed the poison pill so that it wasn't poisonous before Tyco took them over. So remember here, poison pill, it is poison, it is poisonous. It's a great takeover defense because it's a massive flood of outstanding shares that will reduce value. And then a poison put gives the bondholders. So now, what did I say earlier? You were the shareholders, but now you're the bondholders. And so what you can do is you can sell your bonds back to me as the target executive at a super premium. I easily found tons of firms that had poison pills, but I didn't find many firms when I was writing my dissertation that had poison puts. All right, how about supermajority voting provisions? This just means a higher percentage of approval, and then golden parachutes. I'm sure you guys read about that. How about post-offer takeover defenses? We can just say no, right? This is really kind of cool. We can just, put up our hands and say, whoa, we don't agree with any of this. You know what, your offer is embarrassing. How about if we don't even report this to the Wall Street Journal because we don't want you to be humiliated? We're just going to say no. Why don't you guys go back and do some more research, perform some due diligence, and come back when you're serious, when you're going to offer us, like maybe our stock price is 100. What did you offer us? 108. Oh my gosh, we're not even getting out of bed for $108. Come back when you want to offer us $150 or some price like that. Green mail, this of course is a play on words. If that acquirer comes in and buys 5% of our shares, what did I say earlier in that example? It was worth $50 million. Well, we can just say, hey, you know what? You paid $50 million for our shares. How about if we give you $60 million for those shares? The target pays off an acquirer by repurchasing its shares. Whenever you talk about these massive transactions, you always have to consider the concept of leverage. And so there's lots and lots of debt out there. So we can issue a bond to maybe repurchase our shares in that green mail, or we can issue a bond to do something else. But anyway, we're going to issue a bond, maybe repurchase shares, maybe do something else. But notice that this is called leveraged recapitalization. So what we're doing is we're making our capital structure look less favorable to an acquiring firm. Pac-Man defense. I will give you a short personal story that when Pac-Man was introduced somewhere around 1981, my roommate and I almost flunked out of college because of our commitment to mastering Pac-Man. You guys probably weren't even born in the early 1980s. Anyway, Pac-Man was the coolest thing that ever happened to me up until that time in my life. So all we do, Pac-Man goes like this. The Pac-Man, it eats all the little dots. And so we just turn around and make a counteroffer. We can also sue. We can also repurchase our shares. Actually, that's what AMP did. AMP issued a bond and offered a premium over the premium that Allied Signal offered to the shareholder, kind of bribe the shareholders. Repurchase or a crown jewel. A company could just say, hey, you know what? You want this particular asset, right? This particular segment or product line. We're going to sell it over there to somebody else. Therefore, you won't be interested in us anymore. And then these knight defenses or squire defenses. This is what AMP did with Tyco. They brought in a friendly acquirer. And you can do this with a majority or a minority of shares. Now, what did I say back here? What was this one? Litigation. We can sue. And, whenever you sue somebody, you just don't do it without a third person being involved. And that third person is always the government. And so, of course, the government has the politicians. They have rules and regulations and laws that prevent concentration in an industry. And, of course, when there's concentration in an industry, there's something maybe called a monopoly, right? And so, or maybe there are a few firms that monopolize the profits. And so that's an expropriation of wealth from the consuming market to those shareholders in that one or just a few firms. So it makes sense then that the government would want to prevent this intense concentration. And so we have this HHI Index that measures market power. And there's a good old formula for you to look at, but it's probably a lot easier just to work through an example. But before I do this example, you'll have to memorize these numbers. The HHI Index, remember that if it's less than 1,000, that this is no problem. There's no concentration, and there's probably not going to be any kind of government action. And then if it's greater than 1,800, this is guaranteed government intervention. And those of you who follow along financial markets and read the Wall Street Journal on a daily basis, which I recommend you doing all the time, you'll see that the government is almost always interested in mergers and acquisitions because they want to prevent these monopolistic profits. So remember, less than 1,000, no action. Greater than 1,800, absolute action. And then somewhere in between, there's going to be some judgment. The other column that's important in there is the change in this index. So 100 or 50, I would memorize those numbers as well. And so let me just show you what I mean here by a quick example. Let's suppose we have an industry with 6 competitive firms, and notice that the competition is pretty evenly spread. Even though you have 2 firms who are probably considered to be the market leaders, you have another four firms that are right behind them. So here's the question: a merger between 5 and 6, would that give rise to an antitrust challenge? And so what you're probably going to do, just before we go to the next slide, before we even look at that Herfindahl Hirschman Index, we're going to say, all right, so now we're going to have one firm that has 30% market share, and then we're going to have to scratch our heads. Now, this is outside of this LOS. We're going to have to scratch our heads and say, all right, you put these 2 firms together, maybe they'll have 40% market share, but that's beyond this LOS. So 30%, and yeah, you might say, you know what, this is probably a concern. 30% versus 2 20s and 2 15s. Yeah, all right, but let's go ahead and do the math here. So all we'll do is put together a good old Excel spreadsheet. So there are the companies, there are the market shares in the next column. There's the squared market share. There's the index before this potential merger. So notice it sums to 1,700. What that tells you is that the industry is probably pretty competitive. I think the reading uses the term moderately competitive. But then over on the right-hand side, let's go ahead and do the post-merger index. So you do all that and you sum those and you get 2150. So that is two indications here. Let me go back here real quickly. So what did we say here? So more than 1,800 and 50 or more of a change. So where are we here? So we're 2150, so that's more than 1,800, 450. So yeah, this is probably going to be where the Mr. and Mrs. government official is going to knock on our doors saying, yep, we need to take a look at this. All right, back to Modigliani and Miller here. This sounds an awful lot like this came right out of their 1958 paper. Compare discounted cash flow, comparable company, and comparable transaction analysis for valuing a target company. So this has everything to do with, what did M&M teach us? That in the absence of all that other stuff, that the value of a company depends on the quality of its assets, right? I told you it's the ability of its product lines to generate cash flow, whether we want to call it operating cash flow or free cash flow. I mean, we're going to focus on free cash flow here in this example because that makes more sense. And then the weighted average cost of capital. So look at this discounted cash flow analysis. Of course, what we're going to do is we're going to start with revenues and take out expenses, and we're going to do a bunch of other stuff to get to free cash flow. Now, let me remind you of the definition of free cash flow. It's the amount of cash remaining after all expenses have been paid and all investments have been made. So as a good acquiring firm, what we want to do is estimate free cash flow for a target. But we also want to estimate free cash flow for our firm so that we know how much cash we have available if we want to take over another company. All right, so what are some advantages here? So what can we do? We can model cost structure, right? That's pretty easy. And we can estimate operating synergies. We're going to estimate intrinsic value based on forecasted fundamentals, right? So this makes perfect sense. And then, of course, we can modify the model. But then those advantages up at the top, they turn into disadvantages if we're wrong. Look at that second circle point. There is a degree of uncertainty. And notice we have a great degree of uncertainty when estimating free cash flow, not just for next year, but 2 years from now, let alone in perpetuity. Oh, look at that third one there. Difficult to estimate discount rates, and they may change over time. So we have some good models like capital asset pricing model to estimate discount rates, one that we can, or arbitrage pricing theory or some of these other models. So we have good models, but the problem is that if in this merger and acquisition game, we're sensitive to things like changes in stock and bond prices, which we are, and sensitive to changes in economic conditions, which we are, then those discount rates are going to change over time. And then terminal value, that's always a super difficult one to estimate at any time in the future. And then swing back to that first circle point. Applying unprofitable free cash flow within the first stage is difficult. Yeah, that's an understatement as well, isn't it? All right, so think about all the work that you have to do to estimate free cash flow. This is a lot of work. What you can do is you can just sit back, put on your sunglasses and say, hey, there's a similar company over there that was just taken over. That premium was 42%. Hey, let me apply that to my example here. And so, look, this is just a change in value. So we're just going to compute this takeover premium that's based on the deals that have just occurred. Good advantages here, right? If that company is in fact similar to ours, then a reasonable approximation is going to give us a reasonable estimate for what we can expect to happen. Data is available, right? We can just observe that just by reading the Wall Street Journal. And these are derived from the market, right? So you figure those people over there that engaged in that merger or acquisition, they're smart and they did all the work and they came up with, what did I just say, 42%. Well, I mean, we're smart over here, but let's go ahead and piggyback on all the work they did over there. Now, of course, what if those people over there were not too terribly smart, or economic conditions or free cash flow estimates were off? So look, it says sensitive to market mispricing. Could be inaccurate market estimate for a fair stock price for the target company. For that one over there might not be applicable to ours. So look at that last disadvantage, may not be accurate or timely. Now, the great exam question, if I'm writing this, is to put you guys in a position where you have to weigh the marginal costs and the marginal benefits. Just think of those as advantages and disadvantages, right? All right, which one is greater? Oh man, I don't know. That's a great question. All right, how about comparable transaction analysis? So let's go ahead and take a look at past takeover transactions. What we can do is estimate a target's takeover based on that particular transaction, and we can look at not just the takeover premium, but all of the underlying fundamentals that go into estimating that takeover premium. Disadvantages, of course, past transaction values might be inaccurate, and the problem is there might be few comparable transactions. All right, let's go ahead and get to some good old math, right? Look at this LOS. Calculate free cash flows and estimate the company's intrinsic value. All right, so we love all this. Let me just remind you, what did I say free cash flow was? It's the amount of cash left over after all expenses have been paid and after all investments have been made. All right, so look down at the orange box there, right? So we've got this NOPLAT. And then we're going to add some unlevered net income and change in deferred taxes. So let me talk about this here. So there's that NOPLAT right there. So what is that? That's an estimate of the quality of the assets, right? That's revenues minus expenses, essentially. And then we've got to add some income for the effect of leverage. And then we have to add something about these deferred taxes. Remember, you have deferred tax assets and deferred tax liabilities. Let me once again emphasize that the Institute doesn't really require you to be a CPA, but it will require you to understand that according to the accrual basis of accounting, that we may owe something today, but we might not have to pay it until some other time. And so there's going to be a change in deferred taxes. You probably remember that most of these occur because of depreciation methods, but also amortization and warranties and other things like that. And then look at the bottom blue box. This is what I was saying, and all investments have been made, both in the short term, so this reading calls it changes in working capital, and then in the long term, this reading calls that capital expenditures. I always think of capital expenditures are investments in other positive net present value projects. And so think about that estimating free cash flow. It's the amount of cash remaining after all expenses have been paid, all right? And then all investments have been made. So that's a really good generalization of what free cash flow is. And you could probably estimate free cash flow without going through tons and tons of math. I mean, if you just take a look at this example here, you could just quickly look through all that and say, okay, free cash flow is some number. I mean, I'm not smart enough to do this, but I'm guessing some of you are. But the vast majority of us, including me, are going to have to go through the math of estimating free cash flow. So let's go ahead and start with net income. And by the way, all this stuff is given to you in this gray box there over on the left. And so the Institute in the vignette will have to give you some kind of financial statements there. So you'll start with net income. You'll add the tax implications of interest. So what were we told back here? We have interest expense of 30. We have interest income of 24. So you got to take the difference of those two, right? So there's a 30 minus 24, and then multiply that by 1 minus the tax rate, and that gets us to 4.2. So we have this unlevered net income, which we take the net income and then we remove the impact of the deductibility of interest, right? So that gets us to the 104.2, and then our change in deferred taxes. I'm guessing that this would just be, if I were creating a question, I would just give it to you just like this. All right, so we'll add that 26. So there we get our net operating profit less those adjusted taxes. There's our no plat of around 130. So we have to add back depreciation, because remember, when we did net income up at the top, we subtracted depreciation expense to lower our tax liability. Therefore, to get a sense of cash, right, cash generated, we need to add it back in. So that gets us what? That gets us about 170, and that 170 I would call operating cash flow. Cash flow from operations, including the tax implications of all of our decisions. And then we take out short-term investment, right? Change in working capital. And then we take out long-term investment. We call that capital expenditures. So there's free cash flow of 78.2. So what does that do for us with the LOS? Calculate free cash flows for a target company. All right, so we did that part. And I think that working through this math, I think it's pretty straightforward. All of us should be able to do that. All right, how about comparable company and comparable transaction analysis? So let's swing back to that kind of an LOS that we did just a little bit ago. So what are the steps? So what we're going to do is we're going to identify those companies that are similar to us. So the first step then is to try to figure out, how do we want to define similarity? Do we want to define it by product line? Do we want to define it by the magnitude of revenues? Do we want to define it by some kind of a ratio like return on assets? So we've got to define how we're going to identify these similar companies. And then we need to select them, right? And then we need to calculate their relative value measure. So we have price to book or price to earnings. And then we're going to have to sit back and say, all right, we've learned a ton of stuff inside of this CFA program. Let's go ahead and use our judgment, right? Use our natural IQ that's layered with all of this awesome material inside the CFA program, so that we can figure out what's important, what's not important, and what's relatively important, so that we can come up with an estimate of the takeover price. So let's go ahead and work through an example. So we're given a company, target company. We're given some information from the income statement and also some stuff over on the balance sheet. So we're given an amount. We're given some comparables, right? Price to earnings, price to cash flow, price to book value, and price to sales. Of course, price to sales, I never even heard of this ratio when I was back in graduate school, let's say in the early 1990s. But then after we had the explosion of internet and technology companies that didn't have any earnings, we added price to sales in there. And so they're comparable multiples over on the far right column. And so note what we have underneath the table: takeover premium of about 21%. Let's go ahead and estimate this value here. So let's go ahead and do just some quick math. So this is a repeat of the table that we just had. So let's go ahead and multiply our amount by the multiples over on the right-hand column. So we get, the 37, 35, 38, and 36. And we take an average, which is around 37. We assume that takeover premium was around 21% or so. Multiply that by the average, and there's our takeover price, $44.92. How about if we do an example under transaction analysis? And so we'll have to go through, kind of the same and similar steps that we just did. collect data on recent takeover. So we're going to have to scan the environment out there and try to figure out what are those companies out there, what do they look like, what do their revenues, what are their product lines, what are their metrics, what do their ratios look like, and are they comparable to our company or the target that we're interested in. And then we do some multiples, and then we evaluate a takeover based on those multiples. And so here's another example. So we have some amounts of some similarities. We'll use those same kind of multiples, and there's the mean of the multiples in those comparable transactions, and there's the weights that we're going to attach each of those multiple means. And then all we're going to do, so let me just go back there. So we're going to do the same thing, right? We're going to do the same thing, multiply the amounts by the multiple, get that column over there, column C. So there are our estimated takeover values. So now we've got 50 and 58 and 55 and 57 based on these unique and specific ratios. And now we assign those weights. And this is a difficult one. You know, how do we decide what is more important than something else? Clearly cash flow, in my estimation, and in Medigliani and Miller's estimation, ought to be the most important one. There's 35%. So there we do some quick math over there on the right-hand column. There's the weighted average estimate, $56.46. That's in millions probably. All right, moving on to evaluating a takeover bid. All right, bid evaluation. All right, so let's suppose that we have a target out there, and that target price is $100 per share. I'm sorry, the target stock price is $100 per share. And what did I tell you earlier? The average takeover premium is 50%. So on average, we'd have to offer $150 for to take over that company. And so what we're going to have to do is try to evaluate this whole process. So what have we just done? We just spent a lot of time figuring out how do we come up with that price. Maybe it's $160, maybe it's $140. And then what we need to do is take a look at these this illustration here. Look at the right-hand one. The targets management will try to negotiate for the highest premium. So we need to be careful. Do we want to come in with the highest price that we're willing to pay first? Probably not, right? But we're going to have to come up with a price that's high enough. Now look at the left-hand side. We're going to pay a premium to convince the shareholders to give up control of the company, right? Marginal cost, marginal benefit. I love doing this to my children all the time. So clearly, if the stock price is 100, we're not going to offer $104 because the target shareholders are going to shake their head and say, you know what, Jim, that's a waste of time. We're clearly not going to offer $200 because we wouldn't be able to open up our window fast enough for all those shareholders to come to us willing to sell at $200. So we need to figure out what is some happy middle ground. So we'll go ahead and use some super simple formulas here where we're going to compute things like the target shareholders gain and the acquirer's gain. So this makes perfect sense. Why don't we work through a quick example here? So we've got Marcus Engineering, friendly acquisition. All right. And this is important there, with economies of scale resulting in a net present value of $100. So those 100 is the synergy that's expected from this combination. Management teams have agreed on a transaction value of $13 per share. And let's go ahead and figure out whether or not we want to offer cash or we want to offer shares of our own stock. So the table gives us pre-merger stock prices, number of outstanding shares, and pre-merger market value. So here's some additional information. We'll use 0.65 shares to buy 1 share of Salt Bay, or we can offer $13 per share. So look at the question at the bottom. Combine companies' post-merger value and stock price based on each form of payment. All right. So what we're going to do is we're going to use these formulas here to say something like, all right, which one is better? The choice 1, stock offer, or choice 2, the cash offer? All right, so let's go ahead and start with the stock offer. And because of all the math on this slide, it's probably just easiest if we go ahead and read this together. All right, so we must issue around 24 million shares. So we must issue 36 million times that 0.65, right, that we had on the previous page. So if we issue stock, we're going to have to issue 23.4 million shares to those Salt Bay shareholders. Now, let me just make a side comment here. What we're going to have to do is pick up the phone and call the board of directors and say, hey, by the way, do you have an extra 24 million shares that have been authorized? Remember, there's an authorized, there's an outstanding. So the board may have to authorize some extra shares out there, but that's completely irrelevant to this LOS. All right, so let's do the post-merger value of the company. So do I want to swing back here? So there's the 1360 pre-merger value. There's the 396 pre-merger value for Marcus and Salt Bay. So we're going to take the 1360 plus the 396 plus our 100 of synergies, and we'll subtract out cash, right? Because this is a stock offer. So that gets us 1856. So the post-merger price is going to be that 1856 million. So that's, think about that as total market capitalization divided by the 80 million, right? Where do we have that back here? We had the number of shares outstanding for Marcus was 80 million plus the extra about 24, right? So that gets us to post-merger stock price of $17.95. The value paid to the Salt Bay shareholders then is that $17.95 times those extra 23.4 million. So there's $420 million. So the gain to Salt Bay's shareholders then is the 420 minus the 396 here. Let me just go back quickly. So there's the value pre 396. We offer them 420, so they get 24 million. And then our acquirer's gain, our gain is going to be just the difference between the synergies minus that 24 million that accrues to Salt Bay's shareholders. So our gain is around $76 million. So that's where we are under the stock offer. Let's go ahead and work through the math for the cash offer. All right, what that means is if we pay 13 million, right? And so let me just go back here quickly. So number of shares outstanding, Salt Bay, there's the 36 over on the right. So 13 times 36, so that gets us up to 468 million. So we're sending cash to those Salt Bay shareholders of 468 million. So our takeover premium is going to be that 468 minus the 396, and that gets us to 72 million. Our gain then, so we're paying them cash 72, our gain of 72, that gain, that takeover premium to the shareholders over at Salt Bay, that eats into our synergies. All right, this is what I was saying earlier about, if that takeover premium in the market is 50%, man, oh man, it really puts pressure on this takeover to be a positive net present value. So our gain, what was our gain back here? Our gain, if we use stock, was around 76 million. Our gain, if we use cash, is only about 28 million. And so our post-merger value then is we do this just like we did the previous one, right? 1360 plus the 396 plus the 100, but now we're wiping out all that cash. So that gets us down to 1388. And so our stock price will be just 1735. What was it back here? 1795. Here it's 1735. So there's the 1388, and then we only divide by the 80 million, right? Because we're not issuing any of our shares. And so notice that there are a bunch of really, really good questions in here. So compare and contrast gain to Salt Bay, takeover premium, acquirer's gain. Those are three really important questions for the stock offer and then the cash offer. And then ultimately you'll have to decide which one is better for an actual execution and commencement of this acquisition, right? Explain how price and payment methods, this is a good one here. So effect of price and payment method. All right, so there's more confidence. This is really a cool thing. There's more confidence in the realization of synergies that the acquiring firm is more likely to pay with cash, right? If you're the acquiring firm and you're really, really confident that you want to that your estimate, whether it's free cash flows or comparables, that those synergies are going to be realized, you're much more likely to pay with cash, because you don't want to pay with your shares of stock, because once those synergies are realized, your stock price is going to increase. So you're not going to use shares of your undervalued stock to pay for an acquisition. Now notice that second sub-diamond point. Target company shareholders are more likely to prefer receiving stock, right? So, of course, if the target company shareholders know, now that's the big question, if they know about the confidence in the realization of these synergies, they're going to prefer to receive shares of stock, right? Because it's at 100 now. They believe it's going to be at 130 because the acquiring firm executives believe it's going to be 130. But the acquirer stock, if this is used, look at that second main diamond point. The greater of the risk burden is borne by the target shareholders, right? They get something that's worth 100, and maybe it's only going to be worth 80 at some time in the future. Let's skip down to target shareholders' profit will be the takeover premium in the cash offer, right? But it'll be determined by the value of the combined firm in a stock offer. I think that makes perfect sense. High premiums are often attributed to the winner's curse. This is what I was saying earlier. If you have multiple bidders, or if you bid 50% or 60%, you win, right? But you overpaid. That's the winner's curse. Look at that second to last one. Both the acquirer and the target see high stock returns with cash rather than stock offers. I mean, there's no doubt the clear winners in this merger and acquisition and takeover game are the target shareholders. All you have to do is understand a 50% premium paid to target shareholders. It's hard to be a loser when you get a 50% premium. So clear winner are target shareholders. But then if the acquiring firm pays with cash, that's a greater likelihood that those synergies will materialize, and so the acquiring firm shareholders will win as well. Now, I need to make a comment here. This is editorialization. This doesn't have anything to do with the LOS. The target shareholders, they win today. They get all their money, their 50% premium today. But the acquiring shareholders, they may not get their capital gains for some time for the market to realize those synergies that show up in future financial statements and future stock and bond prices. Boy, I could talk about this for an hour or so, but I won't. All right, characteristics of merger and acquisition. Oh, that create value. All right, this is a good one here. So this goes back to, all right, that long-term return. Suppose the acquiring firm pays cash and the longer-term realization of capital gains. This is positively correlated to a strong buyer. Premiums are relatively low, all right? Number of bidders is low, and the initial market reaction is favorable. This is another reason why I always tell students to read the Wall Street Journal, because those first articles will tell us what that market reaction is. They'll say something like, oh, the acquiring firm shareholders yawned today when they heard this news. Boy, we're getting to the end of these LOSs. So carve-outs, spin-offs, split-offs, and liquidation. So I want you to think about this. You have a company that has equity on the right-hand side of the balance sheet, and then it has all these product lines over on the right-hand side of the balance sheet. And so there are ways of corporate restructuring to change the composition of the product lines and the composition of the capital structure over on the right-hand side of the balance sheet. Here, let me just give you a quick example. let's think of a company that hopefully we use all their products. Johnson & Johnson. What do we know? They have essentially three business segments, right? They have the consumer segments, right? Johnson's baby shampoo. They have the pharmaceutical stuff, which includes the COVID vaccine. And then they have the medical devices, which includes the artificial hip that I have that I had operated on about 8 years ago or so. So let's suppose Johnson & Johnson wanted to leverage its hip, and let's just call it Jim's hip replacement, right? So what they wanted to do was Johnson & Johnson wants to take that particular specific product line and add value to the larger company. So what it can do is it can create a new entity, an equity carve out. It can have an IPO and say, okay, this IPO is going to go to Jim's hip replacement. And so shareholders are saying, hey, look at Jim. There's Jim, and a commercial shows Jim. Hey, Jim's out playing one-on-one with his 23-year-old son, and look at Jim. He's dunking reverse on his 23-year-old son, who has just regular hips that he was born with. But Jim is exploding. Look at Jim run the 100-yard dash. And he's beating Bolt, right? What was that guy's name in the Olympics? The fastest human ever. So what do? Everybody lines up for this IPO, and it's a new entity with the sale of equity to outside investors. So there's an equity carve out. Or we could do a spin-off or a split-off where we either create a separate entity and we get shares of the parent, or we create new shares, or we do something else. And then liquidation, I hope that doesn't happen over there with Jim's hip. That's associated with bankruptcy over there. So I just distinguished among those. So probably this is probably a definitional question in which you would be given something in the vignette where they describe Jim's hip replacement and say which would be the better outcome based on the goal of, and then you would have to choose between carve-out, spin-offs, and split-offs. And the correct answer would be, well, whatever they give you inside of those gray boxes up in the vignette. Reasons for doing this restructuring. So change in strategic focus, right? They want to say, hey, look at Jim. He's doing all the superstar stuff. We want to leverage that profitability. We don't want it just to be inside of our shoulder replacement and our knee replacement and our brain replacement or whatever else it is. We want to shift that strategic focus. Maybe there's a poor fit. This goes back to Procter & Gamble selling its Jiffy peanut butter, right? Poor fit. We want to sell a division. We don't want to be known as the peanut butter people or the food people. We be known as Johnson & Johnson's baby shampoo. That's what we want to be known as. Reverse synergy, right? You can separate the two, and what you can do is they're worth more separated than they were combined. Reverse synergy. And then financial or cash flow needs. That should be self-evident. And that takes us through these. Did we have 1,000 of those LOSs? No, we had 2 pages. We had lots of them in there. And boy, I tell you, if I'm writing a vignette on this reading, I mean, it's hard. It's hard to write one vignette and get all of these LOSs in there. And so I'm gonna just go back to, hey, if this relates to M&M, I would write about it.